Taxation. Taxation is a critical component of private wealth management because taxes influence virtually every financial decision, including investing, saving, spending, retirement planning, and wealth transfer. Effective tax planning seeks to maximize after-tax wealth rather than focusing solely on pre-tax returns. Wealth managers must understand how different forms of income, gains, and transfers are taxed within relevant jurisdictions. Tax considerations affect asset allocation, investment selection, account structure, and the timing of transactions. Because tax systems vary significantly across countries and may change over time, advisors must remain aware of evolving regulations and opportunities. A comprehensive understanding of taxation enables wealth managers to develop strategies that enhance long-term wealth accumulation and preservation. Private clients are often subject to multiple forms of taxation, including income tax, capital gains tax, dividend tax, wealth tax, property tax, gift tax, and inheritance or estate tax. The impact of these taxes depends on the client's residence, domicile, citizenship, and the location of assets. Different tax treatments can significantly alter investment outcomes and influence financial behavior. For example, income generated from interest may be taxed differently from dividends or capital gains. Wealth managers must evaluate these distinctions when constructing portfolios and recommending strategies. Understanding the interaction among various taxes helps clients minimize tax burdens while remaining compliant with applicable laws and reporting requirements. A key principle in wealth management is tax efficiency, which focuses on maximizing after-tax returns through strategic planning. Tax-efficient investing often involves selecting investment vehicles and asset classes that benefit from favorable tax treatment. Long-term capital gains may be taxed at lower rates than ordinary income in some jurisdictions, making investment holding periods an important consideration. Tax-deferred and tax-exempt accounts can also enhance wealth accumulation by reducing the drag created by annual taxation. Wealth managers seek to place assets in the most advantageous accounts and structures while balancing liquidity needs, investment objectives, and risk tolerance. Effective tax efficiency can materially improve long-term portfolio performance. Asset location is another important concept within tax planning. While asset allocation determines how investments are distributed among asset classes, asset location determines where those assets are held. Tax-inefficient assets, such as taxable bonds generating ordinary income, may be better placed within tax-deferred accounts. Conversely, tax-efficient assets, including certain equity investments with favorable capital gains treatment, may be suitable for taxable accounts. Wealth managers evaluate expected returns, tax characteristics, and client-specific circumstances when making these decisions. Proper asset location can significantly improve after-tax outcomes without altering overall portfolio risk. Consequently, it represents a valuable tool for enhancing long-term wealth accumulation and preserving financial resources. Tax loss harvesting is a widely used strategy that helps investors manage taxable gains. The process involves realizing investment losses that can offset current or future capital gains, thereby reducing tax liabilities. Wealth managers must carefully consider transaction timing, wash sale restrictions, and the client's broader investment objectives when implementing this strategy. Tax loss harvesting can improve after-tax returns while maintaining desired market exposure through carefully selected replacement securities. In addition to managing capital gains, advisors may coordinate charitable contributions, gifting programs, and trust structures to improve tax outcomes. These strategies demonstrate how thoughtful tax planning can create value without necessarily increasing investment risk. For high net worth and ultra-high net worth families, taxation often extends beyond investment management to include estate planning and wealth transfer considerations. Gift taxes, inheritance taxes, and estate taxes can significantly reduce the value of assets transferred across generations. Wealth managers work alongside attorneys and tax specialists to develop structures that facilitate efficient wealth transfer while preserving family objectives. Trusts, family foundations, charitable entities, and succession planning arrangements are frequently employed to reduce tax exposure and enhance flexibility. Effective planning requires balancing tax efficiency with legal, governance, and family considerations. The objective is to preserve wealth across generations while supporting family continuity and long-term financial security. Liquidity and cash flow planning. Liquidity and cash flow planning are essential elements of comprehensive wealth management because even wealthy individuals can encounter financial difficulties if assets are not available when needed. Liquidity refers to the ability to access cash quickly and efficiently without incurring significant losses. Wealth managers must ensure that clients maintain sufficient liquidity to meet spending requirements, unexpected expenses, tax obligations, and investment opportunities. Cash flow planning evaluates expected inflows and outflows over time, allowing advisors to identify potential shortfalls before they occur. By integrating liquidity management into overall financial planning, clients can pursue long-term investment objectives while maintaining flexibility and financial stability under changing circumstances. Cash flow analysis begins with a detailed assessment of current and projected income sources, expenditures, liabilities, and future financial commitments. Wealth managers estimate employment income, business earnings, investment income, pensions, and other cash inflows while simultaneously evaluating living expenses, debt payments, taxes, healthcare costs, and major purchases. The resulting analysis provides insight into the sustainability of spending patterns and the adequacy of available resources. Scenario analysis is often used to evaluate the effects of economic downturns, unexpected expenses, or changes in personal circumstances. This forward-looking process helps clients make informed decisions and supports proactive adjustments before liquidity challenges emerge. Liquidity needs vary significantly across different stages of life and wealth circumstances. Younger clients may require liquidity for education expenses, home purchases, or entrepreneurial opportunities. Families often need liquid reserves to manage lifestyle expenditures and unforeseen emergencies. Retirees depend on reliable cash flow to support ongoing living expenses and healthcare needs. High-net-worth families may also require liquidity for tax payments, estate settlements, philanthropic commitments, or business obligations. Wealth managers must therefore align investment strategies with anticipated liquidity requirements. Maintaining an appropriate balance between liquid and illiquid assets ensures that clients can meet obligations without being forced to sell long-term investments at unfavorable times. Effective liquidity planning often involves establishing dedicated reserves and structuring portfolios according to time horizons and spending needs. Near-term expenditures are typically funded through highly liquid assets such as cash, money market instruments, and short-term fixed-income securities. Longer-term goals may be supported by less liquid investments that offer higher expected returns. This layered approach helps protect essential spending needs while allowing a portion of the portfolio to pursue growth objectives. Wealth managers regularly monitor liquidity positions, update cash flow forecasts, and adjust strategies as client circumstances evolve. Through disciplined liquidity and cash flow planning, clients improve financial resilience, maintain flexibility, and enhance their ability to achieve long-term wealth objectives.